Many people believe that the only way to become wealthy is to earn a very high salary or start a successful business from scratch. While these are good paths, there is another powerful way to build wealth that many people overlook. It is called corporate ownership. Instead of working only for money, you become one of the owners of companies that make money every day. As those companies grow, your wealth can grow with them. Corporate ownership simply means owning part of a company. This can happen when you buy shares in a company that is listed on a stock exchange, or when you invest in a private company. Every share represents a small piece of ownership. Even if you own only a few shares, you become one of the company's owners. If the company performs well, your shares may increase in value, and you may also receive part of the company's profits through dividends. Over many years, this combination of growth and dividends has helped many investors build significant wealth. Long-term ownership, patience, and investing in quality businesses are widely recognized as the foundations of successful investing. Think about the biggest companies in the world. They employ thousands of people, sell millions of products, and generate billions of shillings every year. The founders are not the only people who benefit from this success. Millions of ordinary investors also benefit because they own shares. Whenever these businesses expand into new markets, launch successful products, or increase their profits, shareholders may benefit as well. This is one reason why ownership is often more powerful than simply earning a salary. Imagine two friends who both earn Kenya shillings 50,000 every month. The first person spends nearly all the money on daily living and luxury items. The second person spends wisely and invests Kenya shillings 10,000 every month in shares of well-managed companies. After many years, the second person may own valuable investments that continue generating income even without working extra hours. The first person may still depend entirely on their monthly salary. One important lesson about wealth is that income and wealth are not the same thing. Income is the money you receive from your job or business. Wealth is the value of everything you own after subtracting your debts. A doctor, teacher, mechanic, software developer, or farmer may earn a good income, but without building ownership in productive assets, lasting wealth can remain difficult to achieve. Corporate ownership allows your money to work alongside thousands of employees, managers, engineers, marketers, and business leaders without requiring you to manage the company yourself. Every day the company opens its doors, serves customers, and earns revenue. As a shareholder, you may benefit from all this economic activity, even while focusing on your own career or business. Many wealthy families across the world have followed this principle for generations. They do not spend all their earnings. Instead, they use part of their income to acquire ownership in profitable businesses. Over time, these investments grow because successful companies usually increase their earnings, expand their operations, and create more value. Patience allows the power of compounding to work, where investment returns begin generating even more returns. Compounding is one of the greatest forces in wealth creation. Suppose you invest Kenya shillings 20,000 today. If that investment grows over many years, and you continue adding more money regularly, your returns may begin earning additional returns. The longer you remain invested, the greater the potential effect of compounding. This is why many successful investors encourage starting as early as possible instead of waiting until you have a large amount of money. Some people fear investing because they believe they need millions of shillings before they can begin. In reality, many investment opportunities allow people to start with relatively small amounts. The important thing is consistency. Investing Kenya shillings 2,000 every month for many years is usually far better than waiting until you can invest Kenya shillings 200,000 at once. Corporate ownership also teaches patience. Stock prices move up and down every day. News headlines, political events, interest rates, and economic conditions can all affect market prices. New investors sometimes panic when prices fall and sell their shares at a loss. Experienced investors often focus more on whether the company itself remains strong than on daily price movements. History has shown that many successful businesses experience temporary declines before continuing their long-term growth. This does not mean every company is a good investment. Some businesses struggle because of poor management, weak products, heavy debt, or changing customer preferences. Successful investors therefore spend time understanding the companies they own. They look at how the company earns money, whether it has loyal customers, whether profits are growing, and whether its leaders make good long-term decisions. Diversification is another important principle. Instead of putting all your money into one company, you spread your investments across several businesses and industries. If one company performs poorly, others may continue performing well. Diversification reduces risk and helps create a more stable investment journey. Many people make the mistake of chasing popular companies simply because everyone else is talking about them. Social media can create excitement around certain investments, but excitement alone does not make a company valuable. Wise investors look beyond trends and examine the company's financial strength, competitive advantage, future growth opportunities, and ability to generate profits. Corporate ownership should also fit into a broader financial plan. Before investing heavily, it is wise to build an emergency fund for unexpected expenses. Paying off expensive debt can also provide a stronger financial foundation. Once these basics are in place, regular investing becomes much easier because unexpected financial emergencies are less likely to force you to sell investments at the wrong time. For Kenyans, corporate ownership can include investing in companies listed on the local stock market as well as, where suitable and accessible, investing in international companies through regulated investment platforms. Local companies provide opportunities to participate in the growth of the Kenyan economy, while international investments can provide additional diversification across different countries and industries. Some employers reward employees with share ownership programs. Entrepreneurs may also become shareholders in growing private companies by investing capital or expertise. Others join investment clubs or savings groups that collectively invest in businesses. Regardless of the path, the common idea remains the same. Wealth grows through ownership rather than consumption alone. Dividends can become an additional source of income. Some profitable companies share part of their earnings with shareholders by paying dividends. Instead of spending every dividend received, many successful investors reinvest them by purchasing more shares. This increases ownership over time and strengthens the compounding effect. Corporate ownership also changes the way people think. Instead of asking only, "How much money can I earn this month?" they begin asking, "What productive assets can I own?" This simple shift in mindset often leads to better financial decisions. Instead of buying items that lose value quickly, they focus on assets that have the potential to generate income and appreciate over time. Learning about investing should become a lifelong habit. Reading annual company reports, following business news, understanding financial statements, and studying successful investors can improve decision-making. Knowledge reduces emotional investing and helps investors stay focused on long-term goals. It is equally important to avoid investment scams. Promises of guaranteed high returns with little or no risk should always raise concern. Genuine investing always involves some level of risk. Responsible investors research opportunities carefully, use licensed investment providers where required, and avoid making decisions based solely on pressure or excitement. Building wealth through corporate ownership is not about becoming rich overnight. It is about making disciplined decisions year after year. Regular investing, patience, diversification, continuous learning, and focusing on quality businesses can gradually transform modest savings into meaningful wealth. Every successful company started with an idea, but it grows because people believe in its future and invest in it. By becoming a shareholder, you participate in that growth. While employees earn salaries for the work they perform, owners share in the value that businesses create. The journey requires patience, but history has shown that ownership has been one of the most reliable paths to long-term wealth creation. Those who consistently acquire productive assets, instead of simply consuming their income, often place themselves in a stronger financial position for the future.